All right, so now for section 3, we're going to take a look at the different forms of business organization, how businesses can be set up. The form of the organization is going to be important because it's going to determine the laws as well as the accounting standards that have to be followed. Now, so we're going to just start off. So the first form of business is a sole proprietorship. And often there's a box on page 77 called a closer look, and they talk about that. Somebody, generally a sole proprietor, it's going to be a business that's operated by one person, so that person usually has to do everything. And so they talked about Emilio, that he owned a gardening service, so he does his gardening service, but he also handles the bookkeeping and everything. And how they mention there about it's a challenge to keep um, their personal records separate from their business records and all of that. So that's important. We have to do that. So definitely a sole proprietorship, that's going to be a challenge. If somebody is in for business for themselves, is making sure that they're keeping everything separate, what they do on a personal level, away from what they do um, as what they do within the business, and keeping the money separate, having separate bank accounts, and so on and so forth. It's important. But a lot of your small businesses, that's how they're going to start. And I imagine for some of you, that's probably what you're going to do. Maybe you want to be a mechanic, or you want to uh, do a yard service, or, maybe you want to do sell. I know one of the guys there does a lot of beadwork, and maybe selling that on Etsy or something. Um, those are all things that people do. They want to, have their own business themselves, and that's really wonderful. But, you know, it's a challenge too, being that it is only you. And we see that here, that a proprietorship is a business that it's only going to last as long as the owner wishes to run the business, or as long as that owner is alive. It passes away with you. If you pass away, there's no one else that can come in and take that over. So that's something to think about as well. And also, you're limited on your expertise. You're limited on everything, because it's only the owner that is in charge and doing everything. Sole proprietorships are private enterprises because ownership of the business is restricted to one person. A private enterprise is any business or organization in which the owner is restricted to a select group of people. The general public is unable to acquire ownership. So this would be one in one way where you couldn't sell a portion of your business to someone else as a sole proprietor. Um, and they'll talk more about this. I think this idea of a private enterprise, will talk about this more. There's a lot of businesses that they're closed in that way. From an accounting perspective, the financial affairs of the business, as we said, have to be kept separate from the affairs of the owner. And that can be a real challenge. Just so I say, so it's always a good idea, set up different bank accounts, keep different, books, all of that, not commingling money. So if let's say you do a job and you get paid cash from a customer, you don't use that cash then to go and buy yourself a coffee, or to put gas in your personal vehicle, or to buy lunch or whatever. You put that money aside separately, it goes into the bank, and then you pay yourself out of that, and that gets recorded through the business, and then you can use it then for what you need. So it's important to do that. And a lot of times, as I say, in a sole proprietorship, it's a real challenge. So legally, a sole proprietorship is not a separate entity from the owner. The assets and liabilities belong to the owner. That means that anything that the business owns, you yourself personally own that, and also are liable for that. The owner has what's called unlimited liability. That means that they would receive all of the net income, but they also suffer any net loss, and are also personally liable for all of the financial obligations of the business. So if the business fails, or if you have a business credit card and you now, aren't making those payments, they can personally come after you for that. Or even if someone gets hurt, maybe you have a sole proprietorship and you have a place of business where people come in and they get hurt, or one of your workers gets hurt, they could come at you personally as well. So a proprietorship uses the term owner's equity as a title in the equity section of the balance sheet. So we see here our accounting map breakdown for the balance sheet. We see, they have assets, liabilities like normal, and they have owner's equity, and then owner's capital, owner's withdrawals, and then they have the income statement just as before. Now, another type of business that is common is what's called a partnership. And that's a business where two or more people work together. They own a business, and they are called partners. Partnerships need what's called a partnership agreement. It either can be written or oral, but obviously it's going to be better. And it's funny. I should insert a funny clip here, but I'm not going to do that. I've been watching there. You've all heard of Judge Judy. There's somebody that they make these little TikToks or little reels of the audio of Judge Judy, but they're acting it out with chickens, and it's really funny. It's cute. Cue that. So it's best obviously not to have an oral agreement. It needs to be written, because you're going to end up, if it's oral, you're going to end up in court. You're going to end up it being in, and it's going to end up being messy. So it's best to have a written partnership agreement in order to manage the business together, and also, most importantly, so you're going to say what each partner is responsible for, but also how the profits and losses are going to be divvied up. Partners are going to use the term partners equity in the title of the equity balance sheet section. And as we see here, the income statement is going to be the same regardless, but we notice on the balance sheet that it's called partners equity. And then again, partner A capital, partner B capital, and so on and so forth. But there's kind of a hitch with this that we're going to come to here. Now, the partnership, it's going to last as long as the partners continue to run the business, or as long as all of the partners are alive. So if one should pass away, then they're going to have to work that out. And that's something, again, in the partnership agreement, what's going to happen, after that, with that other person's equity and what they had. Partnerships, they're also private enterprises, just like the sole proprietorship. So a partnership is, and also another note is that a partnership is not legally separate from its owners, which kind of gets down to our next point there. Partners may be subject to what's called unlimited liability, which means that the partners are jointly responsible for all of the debts of the partnership. So you're responsible, and that gets to the last point there. You're responsible for the debts of the business just same as all the other partners are. And so if one partner is insolvent, they can come at you. But again, you still have that. So if something happens, someone gets hurt, there's, obviously any kind of financial, all of that, partners, they're responsible for that. Now, we'll later on talk about there's other ways that shield that, and we'll talk about that. Now, in a partnership, there's what's called mutual agency, and what that means is that each partner is able to speak for the other partners and also to bind them in business contracts. So one partner could go into a contract that would impact then all of the partners. And again, we'll talk about this. There's, the different types of partnerships. Now, the first is a general partnership. That's where all the partners are going to be subject to unlimited liability, and all partners are general partners. And this is generally what most people, it's the easiest to set up. Now, there's what's called a limited partnership, or an LP. That is included that there's going to be at least one general partner that has to accept unlimited liability, and then one or more limited partners with limited liability, limited to the amount that they invest. And there has, as I said, they reiterate that there has to be at least one general partner. So usually a limited partnership, usually maybe it's one person that's going to do the business, and then there's another person that the limited partner is the one that's just providing a lot of the capital. So they would only, the limited partner would be the one only, or silent partner is what it's called. The limited partner would be the one, they're liable only for what they invest up to. And then the general partner is the one, then they have unlimited liability for what happens. Now, there is what's called a limited liability partnership, or an LLP. That allows partners to have limited liability regarding the misconduct or negligence of the other partners. However, all partners remain personally liable for all other debts of the business. So it kind of helps to shields the partners from, they wouldn't be responsible for misconduct or negligence of the other parties in the partnership, but they'd still be responsible otherwise for all the debts. Now, another type of partnership, and this one is real popular, is called an LLC, or a limited liability company. And that is a special type of partnership that has the same tax treatment as a partnership or sole proprietorship. So, meaning that the money, it only is going to get taxed once, because what's distributed to the partners, what they earn. But it's limited liability and separate legal entity status make it similar to a corporation. So it works almost like a corporation in that sense, in that the partners then don't have liability, personal liability, and also that it acts as a separate entity, separate from the owners. So an LLC is one way, you can, probably the best way to do it, and is that way to shield yourself from that. Now, corporation. Now, corporation is a business that has to be registered with the state government as a separate legal entity from its owners, the stockholders. Now, one thing I will say is a corporation doesn't necessarily need to be registered or, done in the state that it's operating. And so we see that a lot. A lot of companies, they will set up in one state and then they will incorporate in like Delaware or something like that, because Delaware has really favorable laws for that. Whereas, setting up in California, there's, incorporating in California, there's obviously a lot involved in that. But again, it is registered, has to be registered with the state government, and it's set up as a separate legal entity from its owners, which are the stockholders. Stockholders are the owners. So they're able to either issue stock either privately, amongst, or they're able to sell stock. Now, as a separate legal entity, a corporation has all of the rights of a person and is responsible for its own activities and liable for its own debt. So basically, if it's a corporation, it stands alone, and the corporation is what's responsible, not the stockholders. It can enter into contracts and buy and sell products or assets, but it can also sue and also be sued. The corporation can. Now, stockholders are the owners of the business that have ownership of stock, which provides partial ownership of the business. And stockholders are legally distinct from the business, and their financial risk is going to be limited to the amount that they have invested in the forms of shares. So they have limited liability through this. And a corporation's life is indefinite and independent of its stockholders' life, because again, it's its own separate, completely separate legal entity. Now, a corporation, they get managed by what's called an elected board of directors. Members of the board of directors and senior management can be financially and legally accountable for the actions of the corporation, though. So that's something to be aware of, that if there's any kind of misconduct that's taking place, the board members can be responsible and the senior management can be held responsible for that. So that's really important to be aware of as well. The balance sheet for the corporation, they are going to use the term stockholders' equity for the equity section. And then we see there, we have common stock and also what's called retained earnings. Now, corporations can either be set up either as public and private, and it's also possible, I will say, for a company that is a private company to go public, as well as for a public company to go private. And that happens quite a lot. You hear that quite a lot. So a public corporation, it allows its stock to be sold to anyone in the general public who wishes to buy them. Its stock is usually listed on a stock exchange where buyers and sellers trade shares of public companies. So, for example, IBM is a public company. Apple is a public company. Tesla is a public company. So those are all public companies. You're able to buy stock in those companies. Now, a private corporation does not allow its stock to be sold to just anyone. And often the stock is held by either a few individuals or it could even be other corporations. And so a lot of companies, they will start out as public, and then especially if they start having a lot of financial issues, they will go private so that they can work to fix a lot of those, or they'll go private because they get bought up by private equity. And so, for example, an example, kind of an obscure example, but the Avon Products Incorporated, you know, or Ding Dong, Avon Calling, you know, the ladies that used to go door to door. Well, they were a public company and you could buy shares in that company. And then they ended up splitting up anyway because part of it's North America, which is private, which is part of LG, H&H. But before that, Cerberus Capital Management bought them and was involved in that. So it went private in that sense. And then the other part of it, well, it went to Natura. Natura bought them. You can buy stock in the Natura company for the overseas operation. But anyway, companies will often, they'll go private, be a public company, and then they can decide to go private. And then, of course, the board has to vote on that. There's a lot of things that has to happen. But a private corporation does not sell stock. And it happens a lot too. Like, for example, my dentist, he is partners with a lot of, you know, it's him and it was him and he had a couple other people that worked with him. And it might have been set up as an LLC or an LLP, but more than likely it was probably set up as a corporation, just because of the aspects of the liability aspects to it, and also the aspects of the fact that because it stands alone, the corporation is able to, so they're able to get loans and so on and so forth. But it's private. You can't go on a stock exchange and buy shares in that dental practice. You only could do that if you are either the owners, you know, which would be the dentists, the three dentists that are involved, or if you're their family, or if you're interested in investing in it, then you could. But it's not just available. Private corporation, the shares are not just for anybody. So we see here kind of a breakdown, and this also is available for you on page 80 of the text. We see here kind of a rundown again for a sole proprietorship, a partnership, and a corporation in terms of what the owners are called, if it's a private or public entity, how the equity section, what it's called, the amount of liability that the owners have, and also the life of the business. And that's really important, you know, too, when you're thinking about setting up your business, it's important to think about all of these aspects. Now, another type of organization, and I know some of you might be interested in starting one of these or being involved in one of these, is a nonprofit organization. And I know many of you, especially when I taught Business 10, the Introduction to Business course, a lot of you were real interested in this, you know, setting up halfway houses or setting up foster homes or doing, you know, different things, drug rehab centers and different things like that. Those would all be things that generally are nonprofit organizations. And the primary objective of the other businesses we've talked about is to maximize profits. But for a nonprofit organization, their aim really is to improve society and on some level. And they're not looking to make a profit, although they sometimes do have a net income at the end, and they should have a net income at the end. They really are just looking to make sure that their expenses get covered. So their profits are paid out or redistributed to the community by providing the service. And so if they do come out with a surplus at the end of the year, they're going to use that to reinvest it in order to, you know, continue the work that they're doing. Nonprofit organizations include religious organizations. A lot of, you know, obviously your churches and those types of things are nonprofit organizations. Community care centers, so community centers, food banks, as we said, rehab houses, you know, those kinds of things. Charitable organizations that give grants, you know, United Way, county foundations, those kinds of things. A lot of your colleges are nonprofit also. And of course, your hospitals, a lot of them are set up. There are some that are for profit, but most of your hospitals are going to be nonprofit. So the money that they get goes back into treatment, or it goes back in, like if it's a research hospital, if it's like Stanford or UCLA or UCSF or something like that, the money goes back into research to come up with different things or to help. So a lot of your businesses or organizations out in the community, they're nonprofits. One way that they get funding, the main way they get funding is going to be through private donations from people, donations through other private organizations that give grants, and so on and so forth, fundraising, and also through government grants. So state grants, federal grants, local grants, that kind of a thing. Nonprofit organizations, one note is they really don't have an identified owner, because really the community is what owns them. They don't really have and a lot of these are going to be set up as corporations primarily, but they don't have identified owner, but they do require financial statements because they have to be accountable to donors, to their sponsors, lenders, tax authorities. Even though it's a nonprofit and maybe they're tax exempt, they still have to file something with the IRS. So they have to file a 990 with them. They may have to file a form with the state. They still have to do that. They still have to keep books. They still have to be accountable. And so oftentimes they'll have boards of directors. They have CEOs that are in charge of that. They'll have accountants that work for them. They'll have, all kinds of, the same thing that any other business would have. Which of the following forms of an organization is legally treated as a person? So is it a sole proprietorship, a partnership, a corporation, or a nonprofit? And it's going to be a corporation. It has all of the rights and responsibilities that a person would have. And in a corporation, net worth is going to be referred to as capital, stockholders' equity, owner's equity, or partner's equity. And this is within a corporation. It's going to be called stockholders' equity.